Welcome to Trading Nation. I'm Michelle Caruso-Cabrera, and joining us today is Maneesh Deshpande. He is Managing Director and Global Head of Equity Derivative Strategies at Barclays. Maneesh, thanks so much for being here.
Sure.
You've just put out a new note. You say we may be about to enter a new, quote, regime for volatility. Tell us why.
So essentially, one way to think about the price action that happened over the last 2 weeks is that it was not so much about change of fundamentals, but it was change of sentiment, and which was made worse by some technical selling. So the real question for us is that how does this sentiment come back? How quickly do we go back to sort of being uber bullish that we were probably in January?
Tell me, you are not concerned about rising interest rates? A lot of people would argue that something has happened, that interest rates have started to rise, hence the new regime of volatility.
I think that's a good question, but the rates have been rising for some time, so why now? That is one question. And the second question is that our research has shown that rising rates on the long term or sort of medium term are not particularly bad for equities. There is a interim time period when the market worries that perhaps the Fed is changing its stance. That's when you get a little bit of volatility, but it eventually adjusts itself, and you can have rates go up and equities go up at the same time.
Yeah, I see in the note it says our previous research has shown the rate equity correlation has tended to remain positive for 10-year yields above 5%. The rate equity correlation would be, do rates and equities correlate, i.e. move higher at the same time, correct?
Exactly. So below 5%, what tends to happen is that rates and equities move in the same direction. The relationship flips when you go to high rates. And essentially the reason for this is that when you're at low rates, investors worry about deflation, and so rates going down is bad for equities. But then when you're at high rates, then what you really worry about is inflation. So then rates going up is bad for equities. And the whole thing sort of transitions around the 5% level for 10-year rates.
So tell me, what should investors be doing with stocks right now based on your research?
So I think for right now, our base case is that the stock rally will be sort of slow and you'll normalize at a very gradual pace, i.e. what that I mean is that VIX is going to come down slowly to the low teens or perhaps 1 month. The interesting question is that if that happens very quickly, then that's really telling you that the animal spirits are back again in full force. And what that will mean is that perhaps you'll get a very sharp melt-up rally. So I think. Go ahead.
No, finish your thought. I thought it was interesting.
Sure. So, because I think the question is, and the situation right now in some sense is very similar to what we saw in the late 90s, just before the dot-com crash. Because if you remember at that time, valuations were high, but everyone was still, so a lot of investors knew that this was in some sense a bubble, but you were forced to participate because otherwise you would underperform your peers. It's a similar situation right now, that if the animal spirits come back, then you could start to see a melt-up kind of rally, but then you'll have an unusual situation that the market is going up and volatility is going up at the same time.
All right. We'll have to watch for that. Maneesh, thanks so much. Maneesh Deshpande of Barclays. Thank you for watching Trading Nation. I'm Michelle Caruso-Cabrera. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.